Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Welcome back, ladies and gentlemen, to the Family Banking Show. We're your hosts, Derek, Rob, and John. Guys, how's it going today?
Good, Derek.
Good. Well, glad to hear it, guys. This week, we are in my favorite section of Nelson Nash's book in Becoming Your Own Banker. This is the section titled The Problem. What I love about it is Nelson doesn't beat around the bush. He gets right down to it. The problem with most Americans and their finances is not necessarily what most people think. It has to do with interest and banks, which of course is what we love to talk about, guys. In the first paragraph, John, he mentions something about this strategy of becoming your own banker that he thinks is very important to communicate. Why don't you go ahead and explain that to the listeners?
Yeah, he mentions the all-American family. And the all-American family is not the six-figure, maybe even millionaire family with the, golden retriever and the big house. No, he's talking about a family that makes $28,500 after taxes. And granted, this was written in 2000. So with inflation and wage increases, add a little bit, but still, he's talking about a very modest family. And he breaks up their natural spending habits. And I think he's really generous in this, assuming that people set aside 10% of their after-tax income towards savings in one vehicle or another. I actually just looked it up. That last month, the personal savings rate in America was 3.6%. So he's being very generous, And I think that speaks to what we're trying to do here in the Family Banking Show is that you don't have to be wealthy. You don't have to be a high earner for IBC to apply to you. Everybody can save within the scope or income that they produce, and this can still over time really benefit people's families.
Yeah, so let me provide maybe a little bit more context here. In this section of the book, as John mentioned, when Nelson wrote this was back in the year 2000, when he did a study of the average American and how they spend their money. And what we're going to discuss is the different segments in which our dollars go. And for many people at the end of each month, they're wondering, scratching their head, where did all that money come from? I know I got paid this month, but at the end of the month, it just doesn't feel like it's gotten me very far. Rob, he breaks down these categories. Can you explain what some of these are? Are they still applicable today? What's changed?
Yeah, it's still very applicable. Yeah, and this was really when I first read this book, like that was such a shock to me. We'll get to the number here, like the final number, but it was such a shock to me, the amount of money that is flowing out of our control that is just paying off interest to other financial institutions. It's really eye-opening. I think we all do it, but we don't even realize it until you actually look at it. But he breaks it down. 20% spent on transportation, 30% spent on housing, 45% is spent on living. And the living, that's like everything else. Clothes, groceries, charity, giving to your church, boat payments. Bought a pontoon last year, so that kind of resonates with me. Boat payments, all cars, all that stuff. So that's a big number. So then you got 65, so that's 95%. And then he just had that 5% left for savings.
Right.
So pretty shocking.
As John already mentioned, that savings rate is going down and down and down for most people in America today. A couple of comments that are important for us to consider is the way in which we pay these expenses. Nelson says that the balance of our spending or our living expenses is generally paid using a charge card, which is old term lingo for a credit card, or pay cash. And what Nelson really focuses on in that paragraph is the fact that no matter what you do, no matter how you pay it, you're always paying interest. You're either paying interest to a third-party creditor, or you are giving up the interest that your dollars could be earning by paying cash.
Yep.
So in the example, this hypothetical scenario that we're going to go through, guys, Nelson is being generous, like John, you had said. He's going to increase that savings rate to 10% rather than the 5% that was typical when he was doing the study. And even today, I've looked at Vanguard and Fidelity, big institutions that focus in on people's wealth and their investing. And they've done studies on this as well. And they said that the savings rate is maybe between 7 and 8%. But then they quickly tell you that you really need to be saving closer to like 15 or 20% if you want to have a healthy retirement. So it just goes to show you that many Americans are in a predicament, and the predicament is the fact that they're financing these things through other banking organizations. Could be a credit union, could be a commercial bank, could be your aunt and uncle. The problem is it's going to somebody else's bank. And of course, as we like to teach here, how to create your own family banking system.
Mm-hmm.
Guys, let's dig into some of the numbers here. Let's talk about the auto financing package. Of course, these numbers are a little outdated, but the interest rates, interestingly enough, are very similar to today's rates. Is that important for this analysis? How does that play into it?
I think it's interesting that yes, it's important to us, that the rates are almost exactly identical to today. But one thing also I was going to mention is that he mentions the monthly payment. And I don't know about y'all's upbringing, but whenever I watched anyone, my parents, grandparents, anybody in my family, consider if they could afford something or if something's worth purchasing or something they're able to do, I don't really think the interest percentage and we'll talk about this later, the volume of interest was ever noted. It was just, what's the monthly payment?
Mm-hmm.
And when people are considering to refinance a house, well, does it reduce the monthly payment? Do I get, there's so many other factors than just the monthly payment that I think he does note, on a car loan of $10,550 for a 4-year loan at 8.5%, you got a monthly payment of $260, which most people in America would maybe ignore or look over the overall price, the loan terms, and just focus on what that monthly payment is. And if their credit score or whatever else leads to them getting approved to have that $260 a month factor in their debt to income ratio and be approved. And that's kind of the end of the story for most people.
Mm-hmm.
But there's just so much more that, frankly, the banking institutions, these other banking institutions, don't want you to focus on. They don't want you to see the back end kind of profit that they're receiving from these amortized loans. And so this is a very, very applicable scenario for our day today because the rates are almost exactly the same.
And also, I thought it was really interesting. He said, if you talk to the sales manager, you'll find that 95% of the cars that are traded in are not paid for. And so what that I think kind of illustrates the problem is we're just so kind of used to paying interest that we don't even factor that in. We're okay with always paying 20% interest in this example. We're always going to pay 20% interest on a car. We just kind of accept it. Or even if you did one little thing like paying it off and then trading it in, just that little step can help you out. But we're just so used to the number, the monthly bill, that we don't even think of the bigger picture of what does that really mean. So it's just an example of how we're so accustomed to paying other institutions for the ability to use their money instead of taking that back, financing our own personal banking system and capturing that 20%,
Yeah, I think that's so impactful to think about. 20 cents of every dollar that I pay in auto financing is going to somebody else, and I never get to see it again. Not 8.5%, but 20%.
Yeah.
Not the actual interest rate of 8.5%, but it's much, much higher. as time goes on.
Yep.
Nelson makes the comment, and is probably the most important comment in this section. He says, it never seems to dawn that the volume of interest is the real issue, not the annual percentage rate. And as we're talking about volume of interest, what I would encourage our listeners to do is to chart out all of your finances. What are the things that you are paying interest on, that you are leveraging somebody else's money, like a bank? And how much are you paying in interest as a portion of your after-tax income? That's the volume. So if you after-tax income is $100,000, but you're paying out $30,000 in interest, your volume of interest is 30% of your after-tax income. That's just a brief example. That's something that I would encourage people to have in the back of their minds here. It's volume, not rate, that we're talking about here.
Mm-hmm.
Next up, guys.
I was just going to add that if anybody listening owns a home or has ever purchased a home, most closing documents, as far as I know, have what's called the total interest percentage, the TIP or TIP. That percentage is always vastly higher than the APR, than the percent you think you're getting on your mortgage. A few years ago, mortgage rates were really low. Just a personal example, I had a 2.75%. I thought I was just locked into the best possible scenario for a mortgage. But then I looked at the TIP, and it ended up being around 82%, meaning compared to the purchase price of the home, I was, after the 30-year mortgage, going to pay 82% of that on top of the principal in just interest over those 30 years. So the longer the loan, if it's an amortized loan, the greater that volume is going to be. And so obviously for most people, the greatest volume is going to come from those home mortgages.
Yeah, that's exactly the next step that Nelson goes into, is he talks about the housing portion of the All-American family. And this is generally the biggest monthly payment for people,
Yep.
I would say, is their housing expenses. And it's also the one that they're going to be shelling out the most amount of interest dollars to banks, is housing. The example he gives, guys, is a home mortgage with the loan amount being $93,000. And for most people across the US, if you live near a major metro area, you're going to be very hard pressed to find a $93,000 livable home.
In the studio condo.
Even the studio condo.
Yeah.
But of course, this was written many, many years ago. So actually, you should probably take that number and multiply it by 3 or 4.
Mm-hmm.
So be thinking like 300,000 or 400,000. That's more typical for people. The rate on the loan here was 7% in Nelson's analysis, with a monthly payment of just over $600. He goes on to say that the problem is that most Americans either move or refinance within the first 5 years of purchasing a home. Do you guys do you guys think that's still legitimate today?
Mm-hmm. Yeah, I've done that. I think I refinanced my first home twice, and I refinanced my rental property twice. And so at least I've done at least, and it's just when, I was just looking at I was like, oh, my monthly payment's going down, right?
Did you
I wasn't really aware of how much interest you're paying in those first 5 years. It's criminal almost what we're getting charged to own a house. It really is eye-opening.
Rob, just out of curiosity, did you pull equity out of the house when you refinanced?
I did.
Yeah, so some people, when they refinance, what they're doing is they're just shortening the term so that the monthly payment stays the same. Think about in 2020 or 2021 when rates were really low, the refinance market spiked. Interestingly enough, they did analysis on that, and they said, oh, most people aren't actually pulling out equity. Most people are just shortening the length of the term on their loan by the refinance. So some people are smarter than others.
Yeah.
But
But
to think about that point is that many people who are refinancing to pull out that equity, what's the main reason that they're doing it is they don't have a banking system. They don't have a access to an ever growing and increasing pool of capital.
Yeah.
And we're solving and we're eliminating that need to continue these refinance cycles. I know several people in their retirement age who have refinanced 4 or 5, maybe 6 times on their primary home, where they bought their home 45 years ago and they still have maybe 5 to 10 years left on their mortgage. Which, every person's situation is different, and there isn't a one size fits all solution. If there were, then we would all ideally likely be doing that. So that there are specific scenarios, cash flows and stuff like that. But if you needed that equity that is locked in the home, most people go to the refinance so that they can access that. They don't necessarily prioritize reducing the amount of interest that they're shelling out to the banks over having that access to the pool of money that you can otherwise solve for through IBC.
Yeah, and home ownership used to be a virtue in this country of, that's a lot of people. That was one of their main goals in life, was to say that I finally own my own home. And really you don't. You still have to pay property taxes, unfortunately. But yes, you can own your primary residence without a commercial mortgage, or I'm sorry, a residential mortgage on it. But as people and as our culture changes and we undervalue the virtue of home ownership, you're just going to see more and more people refinancing. And even in the real estate investment market, that's often something that gets thrown around, is people talking about pulling equity out of their home because it's just dead money. It's just sitting in your walls. What's your guys' take on that and that philosophy?
Couple things. So one of the first thoughts I had is the risk associated that you don't have any control over. People who refinanced in spring of 2007 probably didn't see anything coming the next year and see their home value plummeting and see them upside down on their mortgage. And while things are going well, things are probably going really well, and those who are able to capitalize on the ever increasing home prices and valuations and pulling out that equity, like, can only go so far. As we know, the housing market is not guaranteed to never drop. And so if you're going to base a strategy on, say you're a real estate investor, you're going to base a strategy on banking that your home equity is going to increase X amount percentage every year. That's just not reality. That's just not what has historically happened, and that's not what I think we can expect with certainty to happen. So there is just tons of risk, unnecessary risk involved in that we can transfer to a guaranteed contract, to a guaranteed certain growth that we all ideally want, but isn't maybe as flashy, as the real estate market. And another thing is you can also never guarantee the rates. You can never guarantee that the banks are going to give you a favorable rate or favorable terms, or even approve the loan overall. So there's just lots of unnecessary risk and unnecessary dependence, on the banks.
Rob, any thoughts or comments?
Yeah, I guess as John was talking about that, and we were talking about all the money that flows out, the next section down, 34.5 cents is flowing out of our control. And what John said in terms of like chasing those better rates or those lower monthly payments. It's just it's just like he talks about how we're looking to just make these incremental increases in like a positive, increase in our positive cash flow, where if we just were being smart about reducing that outflow of cash out of our system, that just pays off such bigger dividends down the road. And he talks about the guys going to the water cooler where they're bragging about getting a 10% return on an investment when 34.5% is going out of their control in interest, I think that's a much bigger area to attack, and a place you can do, I think, more strategically and with more guaranteed results than just throwing money into the stock market and hoping you get a return. So it's just a changing your mindset of how you approach this problem that we're in.
And it's really the same question that many people ask when they're at the water cooler and they're talking about, my Bitcoin went X% high, or GameStop went soaring through the roof or whatever. They're talking about a return of their money. But I truly believe that it's the exact same result. Instead of talking about a return on your money, talking about a return of your money, like not letting all of those dollars go to interest. And he talks about for the mortgages, if in the first 5 years you're paying about 86% in interest, that's a big return. Whether you want to call it a return, rate of return or whatever, you're recapturing that. You're recovering lots of dollars that are otherwise forever out of your system. Another way, to think about it is well, I think a couple good ways. Like one, just you're keeping more of what you're earning so that then you can use it for other opportunities and earn more of what you just recovered or what you just kept. Or just think about it like a boat that has many leaks and you're just plugging those holes and making yourself stronger and building a stronger foundation so that you can stay afloat.
Yeah, I think that's one of the biggest epiphanies to me when I was reading through this book, is the amount of opportunity that I can. So when you take your money and you just throw it into the market, or you give it to someone else to manage and can control for you, it's out of your control. Like the real big epiphany here was, I have all of this 34.5% of my money is going out to entities that I don't control. If I can just attack that slice, that's an area I can actively do something with to improve my financial situation, versus just hoping a money manager somewhere will get me a good return, hoping the market doesn't crash, hoping the market goes up. Like, this is solid stuff that you can take control of based on a guaranteed product, whole life and dividend paying whole life insurance, a guaranteed product. You can build up. If you don't have a guaranteed product, you can't build a process around it. And so that's what really attracted me to this, is there's this big opportunity to play defense, to come out farther ahead playing defense with things that I can control in my own life, than just hoping the market goes up and hoping a money manager is smart with it. Just a big moment for me when I was reading this book.
Sure. Guys, we talked a lot about rates. We've talked about some numbers here that Nelson mentions. The most important ones are 86% of your mortgage payment is going to other banks. 86 cents of every dollar you pay in your monthly mortgage payment is going to Wells Fargo or Chase or whoever owns your mortgage.
Over the first 5 years, yeah.
Over the first 5 years, correct. The other big number that you guys have already mentioned is that 34.5 cents of every dollar of after-tax money that you bring home is being shelled out. You're a third of your living, the income that you actually bring home every month, a third of that is going to somebody else. And you're not really benefiting a ton from it. Of course, we do get some benefit. If you were to advise our ideal client, guys, where do they start? If they see this problem and they realize that, oh, I have the ability to become my own bank, where do we attack? What items do we attack first here? Is the mortgage the one that's the most important, or the one that we ought to prioritize? What would you recommend?
I'd say debt, any debt, for sure, credit card debt. That's the number one. Any of that high interest debt, get rid of that fast as possible. Especially, then some people might argue that, well, I'm putting all my money to pay off that debt. Well, if you're in any area where you're paying extra money to pay off that debt versus the minimum, I'd probably take that difference start building your own personal banking system until you build up enough cash value. Then you can take a loan against that cash value, pay off that debt, basically bring that debt from outside debt to inside debt. But now you have control over it. And now the rate has just dropped massively because what you're getting charged on that loan is way lower than what the credit card company's paying. So you got an instant win there. But then now you control the terms of the payback. So you could then at that point start making minimum payments on the loan with the insurance company and take that extra cash flow that you've just now brought into your life to pay down other debts. And then it just starts to snowball. And it's all because you started this personal banking system based on a permanent whole life policy that gives you all that flexibility, all those guarantees, and all those contractual rights to use it to become your own banking system. That's where I would start.
I agree. Not attacking the mortgage on step one. That comes with time. We think long term when we think IBC, and especially generations to follow, they can definitely capitalize on the housing portion. But if you're just starting, like a lot of us have just started, fairly recently, we're not attacking our mortgage first, and we're not making extra payments with policy loans in our mortgage. Like, we are attacking the smaller stuff that is within reason. And again, we're going to mention this a lot, that everybody's situation or picture looks different, and things that we would advise would be different. But you can still make a big dent based on what Rob just said. Consumer debt, auto loans, some smaller bank debt, and still make a big dent in those first few years.
And one of my favorite ones to draw people's attention to, especially those in my age bracket, is still student loans.
Mm-hmm.
They're still in student loan debt. When we first got married and I inherited a bunch of debt, subtle jab at my wife.
Mm-hmm.
Married the debt too. Yeah.
I married the debt. We were paying 10 to 12% interest on that debt. And, that was back in 2017. I don't know what rates were back then, but probably between 3 and 5%. I cringe to think about, how much is Sally Mae charging on student loans right now? And, for those of you who are maybe got an advanced degree like dentistry, or you're a doctor or something like that, where you're, potentially hundreds of thousands of dollars in debt, trying to climb your way out when you're paying such a high portion of your income to other banks, that's and a great option would be to start attacking the student loans. Guys, there's kind of a buzzword about velocity banking, and Rob, I think you explained it well. Think about those maybe lower balance loans and attack those ones, because now they're adding to your monthly cash flow to pay off those larger balance loans. So that could potentially be something to consider as well. The big thing though is, we don't have to necessarily get bogged down in the weeds and Excel spreadsheet this entirely, because life is fluid and you need to remain flexible. But having something that you've got access and control over allows you to, use that flexibility to your advantage, so that you can take advantage of opportunities if an opportunity comes up, or you could just say, no, I'm good. I'm going to just continue banking here myself. What about this picture of, how long is it actually going to take somebody to where they could recapture their mortgage? Have you guys ever sat down and kind of crunched the numbers on a scenario like that? What are your thoughts if somebody said, I really want to go after the mortgage? How long is somebody really going to have to think about and practice this system in order to do that goal, or to accomplish that goal?
I'd say it depends on the amount of other debt that exists in this family's picture, but on average, anywhere, I think it could be from 5 to 8, maybe 9, sometimes 10 years. But I definitely think it's within reason to think of around 10 years, you'll be at a point where you could potentially have the ability. Maybe it's not the best option for you at that point, but you'll have at least the ability to absorb the entire mortgage into your own banking system if you so choose. That's how roughly it is for my family. I think around the 7 year mark, and looking forward to that, at least consider that option, and totally be free from the mortgage.
Think
Yeah, that
about
brings
the
up the
extra.
question too, is when you get to that point, John, you're like, I could pay off my mortgage. So you get that so there's some people that they're just focused on paying their house off as fast as possible. But once you get to the point where you could pay your house off with a cash value loan, you get that peace because you could. But then you might at that point say, well, now I have $400,000 in cash value. Maybe I look at an opportunity, or maybe I do something that can give me a rate of return higher than what I would have got saved by paying off my house. So it really, you start to get these opportunities. You start to change the way you think when you start to have capital. And that's one of the key points about this. You'll start to notice the more cash value you build up, the more you start seeing opportunities, the more you start to think like a banker.
Mm-hmm.
That's where I think there's a phrase that money is not math and math is not money. For some people, there's such emotion tied to still being subject to a mortgage that first thing they want to do is get rid of that mortgage and absorb it in your own policy loan, in your own family banking system. And that is totally okay. Like I said, everybody's situation is different. And it's not simply a math equation to make these decisions. So we understand, and many people have certain ties associated to different things that they're doing with their personal financial picture.
Sounds good. Well, guys, I've really appreciated the conversation we've had so far and the picture that this paints for the all-American family and the problem with their finances. Once again, just to reiterate, the problem is that you're paying interest to other banks. That's the problem. And it's more the volume of your income that's going to these other banks rather than just the interest rate that they may be charging you on those loans. Guys, in the next episode, we're going to talk about flying a plane, which is one of Nelson's favorite activities as a pilot. We're going to talk about headwinds and tailwinds and how does that relate and apply to the infinite banking concept. Well, until then, guys, I really look forward to that time we get to spend together, and I hope our listeners have gained a lot of value from this episode. If anything that we've talked about so far sounds appealing to you and you'd like to learn more, I'd encourage you to email us at thefamilybankingshow@gmail.com, or feel free to reach out in social media through LinkedIn and whatnot. Just let us know if you have any questions. We're here to help, here to serve you guys. Thank you again for watching and listening, and look forward to seeing you in the next episode.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.